Hello, my name is Crystal Petrie, and you are watching another episode of the Crystal Petrie Podcast, Season 3. Every business needs fuel to grow, and that fuel is capital or money in most cases. But for many entrepreneurs, especially those building from the ground up, figuring out how to raise, manage, and multiply capital can feel overwhelming. Today, we're unpacking smart strategies, real world lessons, and insider tips on how businesses can build the financial foundation they need to thrive. And here to educate me and you on building capital, we have Phillip Woolfolk. Phillip, how are you?
Doing great, Crystal. Thanks for
Excellent.
having me on the show.
Thank you so much for agreeing to be on the show. I'm so excited to have you on to talk about money and capital and all things in between. Now, Phillip, tell us, where in the world are you?
I am in the Garden State of New Jersey. I live in a small town with my wife and daughters, Ewing Township.
Okay, wonderful, wonderful. Now, in my introduction, I was talking about capital. When you hear or when someone says business capital, what exactly does that mean in today's economy?
Well, what it normally means, and I'll give it to you from my perspective as a former banker and currently engaged in alternative lending, is that typically we're talking about money, right? And there, people are looking for some level of funding to be able to move their business forward, if it's a business that's already in existence, or to capitalize the business if it's a business that is a startup.
Okay. Why is business capital such a critical step for business growth?
Well, when you're in business, you have a number of things going on. If you're in business and you're running a successful business, you have revenue, you have expenses, you have all kinds of challenges. Sometimes depending on how your accounts receivable are flowing in. I have some clients that I work with who are doing well revenue wise, but they may be working with customers, sometimes municipalities, sometimes corporate, and different types of clients that may be 30, 60, 90 days out from paying them for the services they've provided.
Mhm.
So sometimes those businesses might need working capital to just to meet payroll, because you've provided the services, you have team members, employees that are working with you to help you deliver those services, but you have a payroll maybe every week or every 2 weeks, and your cash flow is dependent on how quickly you can turn over those receivables. So you may have hundreds of thousands of dollars at some level out there in terms of what you're expecting to come in. But if it doesn't come in by Wednesday, then you have payroll on Thursday or Friday, then you need capital to secure that. So sometimes people use things like lines of credit, and if they've been in business for a while, they've maybe established some reserves to be able to shore up that ability to meet payroll and other expenses in between receiving those dollars that they're expecting to come in.
When I say capital and business capital, I'm thinking money.
Right.
Is that the primary definition when we're talking about business capital? We're talking about money.
Well, when people come to me, they're typically talking about money because they're looking for some means of funding their operations in some capacity. But capital, it does come in different forms. I serve on the board of a for-profit company, and one of the things that is capital for them is intellectual property. So there's intellectual capital. And, if you have a team, you have team members, you have human capital. And so there's capital that kind of falls into different categories. But typically when people come to me, they're not looking for employees, and they're not looking for me to help them with their inventions or intellectual type capital. They're typically looking for funding, but
Okay.
capital does come in other forms, and sometimes those other forms of capital can be used as collateral, especially in the sense of, say, intellectual capital, intellectual property, inventions and things like that.
When What are some of the misconceptions when people are talking about or trying to raise capital?
Well, I think some of the misconceptions is, I've run into folks who, especially sometimes if they're on the startup side of things, sometimes they have the impression that because they have a really great idea, that that idea in and of itself is worth money, and others should be willing to invest in that. Um, but for the most part, especially when you're a startup, most lenders, if they're going to entertain lending money to you at all, they want to know what you're investing. What level of capital do you bring to the table? So if you're not personally invested, um, then a lot of times other folks won't be interested in investing. And if you're coming to somebody as an investor, or looking at them as an investor to potentially invest in your operation, then they're going to typically have the same question. You're looking for $100,000, $250,000, $1 million, or whatever the case may be. How much of your own money is going into this? And if the answer to that is zero, that's probably going to end the conversation.
Right. How does your personal credit report affect your business and your ability to access capital? And this is me assuming that your personal credit report does affect that.
Sure. Well, the way it impacts it is, unless you've been around for a while and you've established through having your business credit or your personal credit meet certain criteria,
Mhm.
then typically you're personally guaranteeing any loans that you take out, even if you're
Okay.
taking those loans out for your business. And that personal guarantee is typically going to hinge on your credit score and how you've handled your credit personally. Then, if you've been around for a while and you've established business credit, then you're at a different level and you're able to acquire capital under your business name and under how your business has responded in terms of how you've managed your business credit. And so then once you're at that level, then you're borrowing money under the business name.
Mhm.
But you asked a little bit about misconceptions. Sometimes, I know I've had conversations with people who have had challenges on the personal credit side. And so let's say they come to you, they have a 600 credit score, and they're unable to get capital under that because of their credit score. Some of them think then they can transition from that to go to business credit and not have their personal credit established. But typically, to build the business credit as a small business owner, you typically need a credit score fit kind of a profile of someone who has a credit score of around 680 or so.
Mhm.
You have 10 or more lines or creditors that you've dealt with that's showing up on your credit report, and you meet certain other criteria to help you to be able to establish credit on the business side. So if your personal credit doesn't measure up to that minimal threshold, then it can be difficult for you to establish the business credit. And you can't certainly trash your personal credit and then completely skip over that and go to business credit, because most times your personal credit is going to be looked at to determine if you fit the profile of a person or entity that can now make that transition over to building the business credit.
Let's talk about self funding. Can you give us some pros and cons about self-funding when it comes to starting a business, establishing a business?
Well, I won't necessarily respond as a pros and cons necessarily, because when you're starting a business, your sometimes your only option is to utilize your own capital,
Mhm.
because you may be in a situation where you're not able to obtain a loan or financing outside of that, and because on the traditional lending side, lenders are looking at historical performance. And so if you have a business that has no history, you're not able to say the this is what my revenue was over the last couple of years. And so you're starting from zero. And so in that case, you may need to fund the business yourself, between yourself and family, friends, partners, whatever the case may be. Um, there are some lending entities. You have the federal government. Sometimes you have state and local county governments that have economic development departments. They may have some flexibility on how they may view your revenue. The SBA, Small Business Administration, will sometimes allow you to be able to project revenues if you have a good, solid business plan, and you're able to demonstrate that you have expertise in a specific area. Maybe you already have clients. Maybe you have contracts already. So you're able to kind of project that your revenue for year one is going to be XYZ. If you have a few contracts already in hand that can substantiate that, then you may be able to utilize that and then leverage that ability in terms of contracts with obtaining additional capital you might need.
How important is it to reinvest your profits into the business?
It's very important. I tell people all the time, sometimes business is a feast or famine situation. So when you're doing really very well, you need to really have some thinking about what happens if my next 2 or 3 months is not as good as my last 2 or 3 months.
Mhm.
And so you should be putting something away, building and establishing reserves, just like you would in terms of your own personal budget. People talk about establishing 3 to 6 months as an emergency fund.
Right.
You should be doing the same thing with your business, because you may run into a revenue or cash flow crunch. And sometimes the revenue or cash flow crunch is not necessarily that you're not generating revenue or you're not generating sales. Sometimes it might be that some of your clients or customers are lagging in terms of the time frame that they're paying you. Like we mentioned earlier, you could be dealing with a client, whether it's another small business, if you're a business to business type of a company, could be a local municipality that's typically 30, 60, 90 days turnaround time on accounts payable anyway. And so during those times, you need cash to be able to continue to meet your obligations, so that you can maintain your credit and you maintain your employees. We look statistically at the fact that most people are living paycheck to paycheck. So if you're a small business and you have 20 employees, for example, they can't go 2 or 3 months without you paying them,
Right.
right? And so they're looking for their paycheck every couple of weeks, and if they don't get it, they're going to get very antsy about that, and they're either going to leave and look for a business that can meet their weekly or biweekly pay needs, or you're going to have some issue with talent, because people may love you, but they just can't afford to
They
stay,
still need to
because
get
they they,
paid.
they still need to get paid, and they still need to meet whatever obligations they have, and they're not going to be able to do that if you're not paying them. So you have to really be able to manage your cash flow, manage your resources as a business, just like you would as an individual. That you want to be prepared for emergencies. And one of the things I've discovered over the years is the more prepared for emergencies you are, the fewer emergencies you have.
Yes.
You
I
know,
love
it's
that.
right. It's when you don't have a dime in your pocket that you need new tires for the
It
car, right?
it is so true. It's so
You know,
true.
and just stuff just happens, you know.
Yes.
But you got 15, 20, $30,000 sitting on the side just in case. The just in case doesn't seem to
Never
come up as
comes. There's
right.
no rain
It
in
doesn't
sight.
come. And the reality is, if you have that in reserve, and now you need four new tires for your car, it's not an emergency, right?
True.
Because you have the resources to be able to cover that. And so, if you're in business, you have to be thinking about that. You can't live on every dime as an individual if you want to have financial success, and you can't live on every dime as a company. When you're having financial success, you have to put something away, like the old folks used to say, for a rainy day.
For a rainy day. And like I said, when you have that kind of money, a lot of times the rain never comes.
Oh yeah.
What kind of mindset do you need to have in order to raise capital and establish capital as an entrepreneur?
Well, in terms of raising capital, it's done in a number of ways. I typically recommend for people that if you're going to be in business, you want to have more than one stream of income,
Hmm.
and you also want to build kind of a portfolio of assets that allow you to not only have emergency capital, but to also have equity, so that if you need to borrow money, you have something that you can use as collateral that makes it readily available for you in terms of raising capital. The other thing that I think people don't really realize is that, lenders are typically looking for two terms of repayment, right? They're looking for a primary source of repayment, which is typically your revenue,
Hmm.
your paycheck, whatever income that you have coming in. That's the primary source of repayment for a loan that you're going to make. The secondary source of repayment is typically the collateral itself. What are you pledging if you don't pay? That's going to cover our potential loss, or our risk of making this loan to you. So if whatever business you're in, if you're also a in the real estate business, and or you have real estate as a mechanism for backing up your ability to borrow, then you have a solid asset. And if you're not over leveraged, you have equity in that asset, allows you to be able to utilize that asset to be able to borrow money that you might need.
What are two or three things that a business owner needs to know and needs to have in order to apply for a traditional bank loan?
Well, I think one of the big things that business owners need to have is they need to have relationships. They need to have relationships with potential lenders, relationship managers who are in decision making roles at their banks, community banks, nationally chartered banks, the commercial banks, credit unions, private lenders, hard money lenders. There are a group of folks out there that fund business operations at different levels, and you want to have relationships with some of those folks who know who you are, they know a
Mhm.
little bit about your business, they know what you do, and they've developed some comfort level with you are who you say you are. They may also have relationships with some of your customers and clients, so they know that you're delivering on whatever your business promise is to your customers. So those are some of the key things in terms of that I think every business owner should have. The other thing is that sometimes people lose sight of the fact that business associations, chambers of commerce, and organizations like that are good to be a part of, because they not only feed into your ability to have the relationships that you might need, but it also feeds into the flow of information that you might not be privy to yourself.
Mhm.
So, I spent some time on the board of the African American Chamber of Commerce of New Jersey as the board treasurer, and then later had an opportunity to spend some time as the chief operations officer for that organization for a few years. And one of the things that I saw is that, you know, for resources, opportunities, and information, business associations have that. They advocate for the business community. They have relationships with folks that you may not have relationships with. And once you're able to establish those relationships and you're able to deliver on your business promise and you've built some credibility, then those are the types of folks that can refer you or recommend you, or you can use that knowledge and that information to be able to move your business forward, to get contracts, to get introductions for other business opportunities. So those are things that are ongoing and that you need to always be engaged in. And then networking is a big piece of it. It's getting out and shaking hands and collecting business cards and staying in touch with people, and
Mhm.
establishing those relationships where people know, like, and trust you, so that when you're looking for business, there are folks out there who are happy to recommend you to their circle.
What are some differences between alternative lenders and your traditional bank lenders?
Well, traditional banks, they have compliance responsibilities, and they
Mhm.
have compliance challenges that sometimes they may look at a loan that they may find of interest. They may not be able to make the loan because of certain criteria, whether it's debt to income ratio, credit score, different things like that. I'll give you an example. I'm working with a client right now, has a property at a one of the shore communities, and property is worth probably a couple $1 million. They're looking for probably about 50% of that. And because of their current credit score and their current situation, they're not able to go to a traditional source. And so that transaction was referred to me, and so I have relationships with strategic partners that do different types of lending. And
Mhm.
and so if you think about it, you have some people they may have money in the bank, they have money in the market, they're not satisfied or happy with the returns that they may be getting at any given time. And because of that, they may decide, okay, I'm going to be a personal lender, right? I'm going to seek out individuals that are looking for funding. Um, I'm not going to do, 15, 30-year loans like a bank would do, but maybe I'll do an interest only loan for 12 months, 24 months.
Mhm.
And then that client can borrow the money they need, do what they need to do, but then they have 12 months or 24 months to refinance that debt and pay me off. um, but that individual who might be getting 0.010% for money in their savings account, they may be able to go out into the market as a private lender and lend $50,000 to somebody and make 13% interest instead of less than 1% interest. And
Wow.
so they're taking that risk. They're putting a lien on your property, and they're allowing you to make monthly payments of interest only. I've been a real estate investor since about 22, 23 years old, and during the pandemic, right as the pandemic got to the point where lenders put a freeze on whether or not they were making loans,
Mhm.
became difficult to get funding, get financing. And because of the nature of the pandemic and not knowing how the pandemic was going to impact me and my business, I reached out to a private lender and I borrowed money for 24 months at interest only. Those loans are typically easier to get. The turnaround time is fairly quick. You know, I think I had a phone call on a Monday or Tuesday, and by that following Monday, I had $50,000. And
Wow.
so I didn't. Turned out I ended up not needing it, and all of my residential tenants and commercial tenants, everybody kind of fared out okay. I had some folks pay a little late. We did our part by waiving late fees and being flexible with folks in terms of how they were making payments. Some folks would pay 50% of their rent on the first, and another 50% a couple weeks after that. But it turned out I didn't have any major delinquencies in terms of folks not having the ability to pay at all. But the ability to get those funds on the private lending side allowed me to have a cushion just in case, so that I wouldn't have to really dip into to other assets to meet our obligations. And so that's kind of the difference. So at the time, and that's not the first time I've used private lenders or hard
Hmm.
money lenders, um, but there's a role that we play in the market in terms of how we're able to support the business community in terms of what they may need at certain times. The cost of the funds typically may be higher, but if you're running a business and you're running a profitable business, everybody would like to have a loan at 5%, but sometimes a loan at 10 or 12%, rather as opposed to not having the capital at all,
Right.
makes the difference between you staying in business or not.
What does someone need to have on their financial portfolio to make them more attractive to get a loan?
Well, I share with people all the time. I talk to folks who are doing well, and one of the things I say to them is,
Hmm.
you know, you don't necessarily want to wait till you need the money to borrow the money. One of the things that made me attractive to the private lender was the fact that from an asset standpoint, from a revenue standpoint, I didn't look like I was starving for the money, right? People don't like to lend money to people who are starving for the money. Um, you know, and over the years, I've been able to obtain lines of credit and different things like that, but I typically do it as a part of a strategic plan and not seeking those dollars when I really need this money by next week.
Hmm.
It's like an emergency kind of a loan. Those are typically a little makes it a little more difficult, a little more challenging. And so, you know, people need to plan their business and plan their financing needs around their business. And so, if you have a 3 year plan, a growth strategy that you're going to need X number of dollars, and you've had the last couple of years have been really good, and 2 years from now you're going to need X number of dollars.
Hmm.
My recommendation is always then start putting those lines of credit, start putting those requests for the dollars that you're going to need 2 years from now. You know, my recommendation is get the money in place now,
For a
because
financial portfolio?
for so that you're basically able to you have the funding that you need for opportunities that might be coming, or
Hmm.
for plans that you have for the growth of your business. And so if you don't need the money right now, but you're able to secure, say, a line of credit, for example, where you have the line of credit in place, you're not paying interest on those dollars until you actually start using them, but the line of credit is there. And so it's easier sometimes to get that line of credit in place when your business is doing well, you're profitable, you have good cash flow, and all those things are working in your favor, as opposed to waiting and potentially having a bad year in between the time you need the dollars, and then maybe not being able to get those dollars if you wait too late.
Moving on to talking about investors, how does an entrepreneur, a business owner, know when to seek out investors for their company instead of going the loan route?
Well, it depends on your business. Not every business, I would say, is a business that is going to be attractive to investors,
Hmm.
unless those investors are, close family friends, family members that want to see you succeed. They want to play a part in that, and you're able to provide some level of return to them, for the funds that they put into the business. Um, for the most part, when you're looking at a small business that has not scaled to the point where it would be attractive to larger larger investors,
And what about smaller investors too?
yeah, and even smaller investors, you people are looking for returns, and so it depends. If you have an opportunity that offers some level of returns that makes sense, then small investors might engage in that. But
Hmm.
if your returns are returns that they're already getting or have the ability to get, say in the stock market, for example, if they're more comfortable, investing in larger market cap type companies, then they may not be interested in taking a risk on a smaller startup, for example.
Right. How do you keep ownership and control of your company when you invite investors in?
Well, if you're inviting investors in and you're issuing stock, for example, you want to make sure that you maintain a controlling interest. So let's say, for example, you have 100 shares. You want to make sure that 51, 60, 70% of those shares stay with you. Otherwise, you're turning over ownership, and you're turning over the ability to control what happens to the folks who are buying into the company.
Mm. What about grants and government programs? What are some government programs? One or two, I'm sure there's a lot of them out there. But what are some government grants that exist to help small business owners to
Oh,
get capital, to get money?
oh, sure. Well, one of the things I typically share as a resource here in New Jersey, and there's similar resources around the country in various states, is that you have economic development departments,
Hmm.
sometimes in municipalities, local municipalities, county municipalities, and then at the state level, you have redevelopment authorities, you have economic development agencies. Here in New Jersey, we have the New Jersey Economic Development Authority. We have the New Jersey Redevelopment Authority. We have the Business Assistance Corporation, and we have those entities that are state governmental entities that sometimes provide grants, and sometimes those grants are to specific industries.
Hmm.
And so, if you fall into those specific industries, there may be grant opportunities that come up. For example, through the Economic Development Authority here in New Jersey and the Redevelopment Authority over the last couple of years, during the pandemic and then post-pandemic, there were lease grant opportunities. So organizations that were leasing space for their businesses could apply for lease grants and basically have payments to their landlords made through those agencies for a certain period of time, and that's free money. And so you have those opportunities. Sometimes there are banks that participate with the Federal Reserve, and Federal Reserve might provide those banks with certain dollars, and sometimes they will offer grant opportunities. And that's another reason to be involved with business associations and chambers, because sometimes those organizations, they're looking for people to provide those grants to. Um, if they don't have small business clients that come to mind, readily come to mind for them, sometimes they will reach out to organizations to see, do you have members that fit these particular criteria, and if so, can you refer them to us for these potential grant opportunities?
How does tax credits and incentives play into building capital? And this is me. Does tax credits and incentives help you build capital?
Well, sometimes there are, like you have research and development tax credits, you have employee tax credits.
Hmm.
You have certain governmental incentives that you can apply for, and sometimes if you're eligible for those types of opportunities, then sometimes they are dollar for dollar opportunities in terms of incentives that that will accrue to your bottom line. So it certainly will help. That's not a, you know, those are not avenues for raising capital for startups typically. These are businesses that have been in business, that have made investments, that have employees, that fit whatever the criteria might be for them to be eligible for those tax incentives. And so I wouldn't look at that necessarily as a capital raise type of a situation,
Right.
as much as it's a somewhat of a reimbursement for money that you may have already spent. But if you are a business that's looking for capital and you're entitled to certain incentives,
Hmm.
then you certainly may be able to close the gap between what you need and what you're getting in incentives. So it may reduce the amount of capital that you need in terms of if you're looking for funding in terms of loans.
Once you get the capital, whether that's through government aid or loans or investors, how do you manage it wisely?
Well, typically when you're going to a bank or an entity for a loan,
Hmm.
they want to know the use of proceeds. So they're typically going to say, Crystal, you're coming to us for $100,000. If we approve this loan for $100,000, how are you going to use it? And so then you're going to say, 50,000 of it is for payroll, 25,000 of it is for raw materials because we manufacture XYZ, and because we can purchase a larger amount of raw materials, it'll reduce our overall cost. So we take those products to market at a lower cost because we're able to buy a larger quantity of raw materials. And so now when we sell our widgets for $100, instead of our profit margin being, $50, our profit margin, because of that larger purchase of raw materials at a reduced rate, now our profit margin is that instead of making $50, we make $75.
Hmm.
And so, you're gonna have to think through what are you going to use the funds for, and that's going to help you better manage how you're going to utilize those dollars when those dollars come in. And if you're able to implement and execute whatever strategy you have in place for using those dollars, then that's going to help you make better use of it, and it should help drive your revenues forward and increase your bottom line.
And I would say that you need to have that in place before you get the funding,
Oh yeah.
knowing how you're going to use it, where you're going to use it before you get the money, correct?
Oh, absolutely. That's something you want to have already thought about, because you don't want to go into a bank or a lender and say I want to borrow $100,000, and they ask what you're going to use it for, and your response is haven't thought about that yet.
Hmm.
Your credibility as a business person kind of goes out the window if you want to borrow $100,000 and you haven't thought about what you're going to use it for yet. Then I can tell you as a lender myself, my thought is going to be, if you haven't thought about what you're going to use it for yet, Then when you get it, what are you going to do with it? And am I am I going to be repaid based on your lackadaisical attitude about what you're going to do with $100,000? That's something you should have well documented before the conversation.
How does a business owner know whether to reinvest in the growth of the business or build the reserves of the business?
Well, you really have to do both. Um, and the good thing is, if you're if you're building adequate reserves, then those reserves give you the ability to also be able to reinvest. And so you really want to be thinking about it as a two-pronged approach. You have dollars that are coming in that you need to meet expenses,
Mm-hmm.
and you have, hopefully, in terms of your profits, you're making more than you need to exist. It's like an individual with a paycheck. You have certain amount of money coming in when you get paid. You don't want to spend every dime. You have certain obligations and certain commitments, and then once those commitments are made, then what do you have that you could save or invest? So, it's all about really paying yourself first as an individual when you're getting a paycheck,
Mm-hmm.
and then paying your business first when you're a business. So you have to look at it that the dollars that flow into your company, they're not your dollars to do with as you please. You
Right.
have a certain amount of money that you have in terms of your regular operating expenses that have to be met, and then you have dollars over and above that. Some of those dollars are dollars to be placed in reserve. Some of those dollars may be dollars that are utilized if you're a manufacturing company, or you're creating something that requires the purchase of raw materials. You're a retailer that requires you to restock your shelves. Then a certain amount of what you bring in automatically has to go back into that. Otherwise, at some point, someone walks into your retail establishment and there's nothing on your shelves. You look like you're going out of business. And so, if you sell 10 widgets off of your shelf, and those are popular widgets that people are buying on a regular basis, then some of the money you bring in revenue wise has to go back to putting 10 more widgets back on the shelf.
Right, right. If you could give one piece of advice, and you've given plenty throughout this conversation, Philip, but if you could give one piece of advice, one golden rule to a business owner, whether that's a small, medium, large, what advice would you give them about building capital?
Well, what I would say is, and this goes to individuals and goes to business owners, and that
Mhm.
is, you can't grow and build a sustainable business, or have a sustainable personal life in terms of of revenue and building assets and all of that, if you're living on every dime. and
Mhm.
and and sometimes, I think people get caught up in the lifestyle of that they're seeking, and sometimes because of that, they make unwise decisions as it relates to things that they might purchase, uh, purchasing a lot of what I call depreciating assets. um, I've advised people over the years who have, you know taken huge pieces of their revenue, whether it's for paycheck or whether it's a business revenue, and they've gone out and bought their dream car, for example.
Wow.
And
Okay.
and sometimes it's not a purchase, sometimes it's a lease. And so, you know, if you're leasing a car for $1,000, and you don't own a house yet, that might not be the best use of that $1,000. And that $1,000 might put you in a financial situation where now your debt to income ratio may be too high for you to afford to buy a house. And so and so your priorities, whether you're an individual looking to build a successful financial life, have a
Mhm.
successful financial existence, or a business person, is to manage those resources that flow through your fingers um, in a way that's going to help you do better long term, as opposed to doing better or appearing to be doing better in the short run. I've heard. I don't know if you're familiar with Dr. George Fraser. Talks a lot about
Yes, I am.
finances and family finances and all of that. He often says that he'd rather have a plastic bag with $5,000 in it than a Louis Vuitton bag with
With
nothing in it,
zero in it.
right?
Yes.
You
Yes.
know, so we have to get out of this mentality of looking successful. It's interesting. Another thing that Dr. Fraser speaks to is, wealthy people stay wealthy by pretending to be poor, and poor people stay broke by pretending to be wealthy. And
Hmm.
so, you have to kind of have your priorities in order as it relates to how you want to do long term, and some of that has to do with putting some of those toys that are depreciating assets off into the future when it makes more sense for you to do that.
What would you say at this point in time, Philip, is your intention in this space?
Well, one of the things I do, from conversations we had that have had, that I'm a speaker, coach, author, and alternative lender. In the alternative lending space, one of the things I enjoy doing is working with businesses, aspiring entrepreneurs, helping them to basically help facilitating the funding they need to be able to grow and expand their businesses. Because I think from a legacy standpoint, it's one thing to be in a position where you have that good paying job that
Hmm.
we're all told growing up that you want to go out and get. But I think that everybody needs to have their own revenue source. I spent about 25 years in the banking industry. I spent most of those years with an unsigned resignation letter in my briefcase. And one of the reasons for that for me was to keep me focused on building and establishing my own revenue source outside of my job. And that has allowed me to have some success over the years by having that mentality and pursuing and growing my own revenue stream outside of my job. And that allowed me back in September 11th, 2001, when the terrorists were attacking the country. At the time, I was vice president, fair lending manager for fair lending compliance, and I happened to be at a fair lending conference right across the highway from the Pentagon. And in that environment, I decided I wanted to spend more time at home with my family, with my wife and my daughters. It took me about a year to transition out of that uh, position. And I was told before I left that basically nobody resigns from those jobs. They when you reach that level, receiving stock options and bonuses and all that, those are jobs people retire from.
Hmm.
They don't leave at 43 years old and say goodbye. But because I had established a real estate investment company and had grown it to a certain level, allowed me to spend 5 years at home, golfing, camping, and swimming, and enjoying my family. And so I recommend to people, no matter how good of a job you have, you need to have your own business, your own revenue source. And of course, we've seen it in the environment over the last few years. You know, with the closing out of backpedaling of DEI and all those kinds of things, and what the impact that has had on our community. And so it's a lot easier to take when you can pay your bills with or without the company's paycheck.
Right, right. Now, my final question for you, Philip, who do you think would make a great guest on the podcast? But You have to help me get them on.
Oh, no, no problem at all. I text right before we started this call,
Hmm.
a colleague of mine, Kathy Ann Wilson, who has an interesting business model, and she's a paralegal, and I think she'd make a great next guest for you.
Thank you. And thank you so much for being on the podcast and giving us your time and your knowledge and your wisdom. We all, especially me, appreciate it.
Well, thank you very much, Crystal. It's been a pleasure being on the show. I look forward to continued collaborations.
Yes. To my community, thank you so much for tuning in and watching. You can get Philip's podcast and all of my other podcasts on YouTube Podcasts and Apple Podcasts. And remember, you always have time to listen and learn on the go.